Thank you, Jeff, and good morning and welcome to part three of Union Bank and Trust Company's fiduciary training webinar. This week we're going to be talking about reporting and disclosure. Reporting is the information that plan sponsors provide to the government, the IRS and the DOL. The disclosure aspect is the information, notices, and documents that the plan sponsor provides to participants. As Jeff said, as always, I'll be glad to take any questions at the end of the presentation. And as always, if you'd like to email me or call me after the presentation and ask me any questions, I would be glad to do so. To avoid a checklist type of presentation, I'm really only going to hit the highlights, especially when it comes to the content requirements for the various disclosures that we're going to be talking about. That said, you can use this presentation as a checklist, and I think the most important takeaway here is that you can use this checklist type of presentation to make sure that your enrollment packets are complete, that you have everything in your enrollment packets that you provide to new participants that you need to have in there. If you don't know that whether you've got a complete enrollment packet or whether it's the current materials, I would encourage you, if you're a client, to contact your Union Bank relationship manager. Keep in mind, we're not going to cover all of the various notice requirements. For example, there are notice requirements that need to be provided to participants when they receive distributions. And then finally, we're going to close with a brief discussion about providing disclosure materials to participants electronically. And then as a kind of a commercial or a preview to next week, I certainly want to encourage you to attend next week's webinar, because it's really going to kind of be a wrap up of some of the things that we've talked about and give you some concrete steps that you can take to minimize the liability with respect to sponsoring a 401k plan that's participant directed. So reporting, the big reporting document is the Form 5500. It is an annual report that's filed with the Department of Labor, and then the Department of Labor forwards that to the IRS, and one or both entities really use that Form 5500 for a couple of purposes. It can certainly contain audit red flags. It also provides a wealth of information that the Department of Labor and IRS can use to provide information to the public as far as plan size, how many plans, and some trends that's going on in the area. There's three types of Forms 5500. It depends on the size of your plan, whether you're going to file a 5500 or a 5500 short form or a 5500 EZ. And that EZ form is actually an IRS document that just gets filed with the IRS and not the Department of Labor. I did not include in the materials and I'm not going to talk about the several schedules that could accompany your Form 5500 filing, because a lot of our clients, frankly, are using that 5500 SF short form, and there's not many schedules that apply. If you have any questions about Form 5500 schedules, you can talk to your Union Bank relationship manager. So 5500 is going to be filed by a large plan filer, and a large plan filer is a plan that has 100 or more participants at the beginning of the plan year. And a participant means anybody with an account balance and anybody who's eligible to participate in the plan, but who does not have an account balance. So for example, let's say I have a 401k plan and there's an employer match and there's no other contributions. There's an employee who satisfies the plan's eligibility requirements, is eligible to make a 401k deferral election, but elects not to make any 401k contributions to the plan, and so he or she would not receive a matching contribution. That person might never have an account balance in the plan, but because that person's eligible to participate in the plan, that person is included in the participant account in determining whether that plan is going to be a large plan filer or a small plan filer. So if we have fewer than 100 participants at the beginning of the plan year, then we're a small plan filer and we're going to file that Form 5500 SF for short form, provided that we don't have any employer securities in the plan and that our plan assets have a readily ascertainable fair market value, for example, publicly traded securities and mutual funds. Even if we go above that 99 participant figure, as long as we keep it under 120 or fewer, we can still retain that small filer plan status. Form 5500 EZ, as I said, this form is filed with the IRS and not the Department of Labor. And that's because an entity that can file a Form 5500 EZ by definition won't have any employees covered under the plan as defined by ERISA. So here, if you've got a sole proprietorship, it's the plan only covers the owner and or the owner's spouse, or if you've got an LLC or a partnership and the plan only covers those partners and or LLC members and or their spouses and no employees, then we can file a Form 5500 EZ with the IRS, and if those plan assets are $250,000 or less, we don't even need to file the Form 5500 EZ. But that said, if you are in this situation, I think the best practice is to file that Form 5500 EZ with the IRS, even though you don't have to. And the reason for that is that filing of the Form 5500 EZ will start the statute of limitations running on a particular year. Before I move to the audit requirement, I want to repeat something that I said last week, is that if you are in a position that you haven't been filing your Form 5500 for 1 or more years and you're paranoid about putting yourself on the Department of Labor's radar, I would encourage you to take advantage of the Department of Labor's delinquent filer program. As I mentioned last week, we have had success with that program, and it can dramatically reduce the penalties associated with filing a delinquent Form 5500. So if you haven't filed for years, talk to your Union Bank relationship manager and let's get that straightened out. So audit requirement, it's really a large plan filer issue, and for those large plans out there, you know that you have to get a written opinion from an independent qualified public accountant, and you also know that that is a fairly expensive proposition. And I would encourage you that if you haven't sent out your large plan for a 5500 RFP recently, I would encourage you to do so to see if you can lower those expenses a bit. Small plans typically don't have to have an audit requirement as long as 95% of those assets are in plan assets are invested in qualifying plan assets. If this requirement 95% is not met, that then those non-qualifying plan assets must be covered by a bond, and that's different from the normal bonding rules that we talked a bit about last week as an audit trigger. That said, a lot of Fidelity bonds will actually cover this non-qualifying asset situation. That said, though, qualifying plan assets includes mutual fund shares, and you can see about 3/4 the way down on the screen. And so as long as you have mutual fund shares in the plan, you're not going to have anything that's not a qualifying plan assets, and that allows you to get out of the audit requirement. The Form 5500 is due the last day of the 7th month following the close of the plan year. So that means if you have a calendar year, plan year, the due date is July 31st. If July 31st falls on a Saturday or Sunday, that due date is rolls over to the next Monday. You can get an automatic 2.5-month extension on the 5500 by filing a Form 5558 by July 31st. Most of our clients, we do file an automatic extension just in case there is a snafu and the regular Form 5500 isn't filed on a timely basis. But so what happens is if you don't file your Form 5500 on time, but you have filed that 5558 by July 31st, you get an automatic 2.5-month extension. So for a calendar year, plan year, that means that 2.5-month extension goes to October 15th. Because this year, October 15th fell on the weekend, the due date for the extended deadline for the Form 5500 fell on last Monday, and I'm pleased to say all of our clients filed timely, in fact, and we only had a few clients that waited till the last moment to file this. So that's one way you can get an extension on the 5500 is by filing the 5558. The other way is you can get an automatic extension on your 5500 if the employer's tax return is on extension. And so what you do there is you include a copy of the employer's tax return extension with the Form 5500, but that extension is going to end earlier than October 15th. And so if you want the full 2.5 months extension, you need to file the Form 5558 by July 31st, even if your employer's tax return is on extension. And here's an example of that interaction between the employer's corporate return on extension compared with the Form 5558 that I'm not going to go over. The other thing, reporting information that goes hand in hand with the Form 5500 is the IRS Form 8955 SSA. What this document does is Union Bank, on your behalf, provides this notice to the Social Security Administration of any participant who has a deferred vested benefit. And so what happens is, well, first of all, the due date for the 8955 SSA is the same as the Form 5500, and if you you can extend it out another 2.5 months using that Form 5558. So in that respect, it mirrors the deadlines for the 5500. And what this report does is it's a notice to the IRS that gets forwarded to Social Security in the year after the year in which a participant terminates, and that participant terminates with a vested benefit under the plan. So if I terminate employment in 2018 and I haven't received a distribution of my entire account balance, then the plan's going to have to file this 8955 SSA for 2019. And then what happens then is when I'm eligible for Social Security benefits, the Social Security Administration will send me a letter that says, hey, John, you might have some benefits available to you under the Union Bank plan. So what happens if between 2019 and when I'm eligible for Social Security benefits, that I receive a distribution of my entire account balance? Then what happens is Union Bank will file an updated 8955 SSA saying that I received a distribution of my entire benefits, and as long as everybody does their job along the line, when I get to Social Security age, I'm not going to receive a notice from the Social Security Administration. That said, though, it's not uncommon for somebody along the chain not to do their job correctly, and where we really see where it comes into play is when a plan moves from one provider to another provider, and the new provider doesn't know necessarily who's been reported or not been reported previously on the 8955, and occasionally that'll fall through the cracks updating the 8955 with a terminated participant who has received a lump sum distribution. And then what happens is Social Security Administration tells the participant they might have some benefits in Union Bank. I take this letter to Union Bank and I said, hey, Social Security says I've got benefits at Union Bank, when in fact I don't, because I received a lump sum distribution at some point. And then what happens is the plan sponsor will have to prove to the participant that he or she received a lump sum benefit, everything that he or she was entitled to, and there's no benefits left. Disclosures. This is, again, the information that the plan sponsor is required to provide to participants. And for these purposes, anytime I use the word participant, I mean anybody with an account balance, including beneficiaries and alternate payees under a qualified domestic relations order, as well as participants who are eligible for the plan but don't have an account balance under the plan. Summary plan description. It's a plan administrator responsibility. If you're a Union Bank client, we prepare the SPD for you if you've adopted Union Bank's pre-approved document. The SPD is an enrollment kit type of notice, so make sure when you've got new participants coming on board that as part of the enrollment kit, they receive a summary plan description, and they need to receive that no later than 90 days after he or she becomes a participant. However, as we're going to see in a couple of minutes, there's more than one disclosure that needs to be provided before an employee becomes a participant in the plan, and so you really do need to put these enrollment packets or kits into new participants' hands before they are eligible to participate in the plan. The SPD must be updated periodically. If there's amendments to the plan every 5th year, if there's no amendments to the plan every 10th year. I'm not going to talk about the contents of the SPD other than to say it really is a summary of the life cycle of a retirement plan: eligibility, entry date, participation, contributions, vesting, and distributions. One thing I do note, especially if you have a workforce where there's a sizable portion that are literate in a specific language other than English, then you need to be aware of the SPD foreign language requirement. And what that requirement is that you need to provide notice to those foreign language speaker participants written in that specific language, stating that assistance in understanding the summary plan description is available, as well as contact information for the plan administrator. And the Department of Labor provides a model notice if you need to provide this this notice in a foreign language. If you're a small plan, then you need to provide that foreign language notice. If you have fewer than 100 participants on the first day of the plan year, the foreign language requirement will apply if at least 25% of your participant pool is literate only in a particular foreign language. So, for example, if I have 10% of my participants are speak Spanish, 10% of my participants speak Vietnamese, and 10% of my participants speak Chinese, well, I've got 30% of my participant pool who are not literate in English, for example, but I don't have 25% literate in any one specific language. So technically, I am not subject to the SPD foreign language requirement. If I am a large plan, 100 or more participants at the beginning of the plan year, then I will need to comply with the foreign language requirement if the lesser of 500 participants or 10% of all participants are literate only in that particular foreign language. So, how do we update the SPD by not providing a new revised SPD? Well, you can provide a summary of material modifications. This is also a plan administrator responsibility. This is also an enrollment packet type of document. And Union Bank, again, if you're a client, will prepare this SMM if you have adopted Union Bank's pre-approved document. And what that SMM does is it describes material changes made to the plan or changes that are required to be in the SPD that have changed, that have been revised since the SPD was last distributed. So what is really happening is that SPD for a new participant will include the most current SPD and any summary of material modifications that supplement that SPD. You need to provide that SPD within 210 days, basically the end of July, for a calendar year plan after the close of the plan year in which the amendment was adopted. So if you've adopted an amendment that requires an SMM to be provided to participants, and you adopted that plan amendment sometime in 2018, then you're going to need to provide that SMM to all participants no later than the end of July next year. Again, like the SPD, the SMM really deals with the life cycle primarily of a retirement plan. That said, if there's any change in designated fiduciaries under the plan, like plan administrator, trustee, or plan sponsor, you need to provide an updated SMM to let your participants know who these new fiduciaries are. That brings us to the summary annual report that we provide to clients. Along with the Form 5500, and that SAR is really a summary of the Form 5500 filing, and it's not enough that you provide the Form 5500 to participants, because that's gobbledygook for participants, but this SAR is really an annual summary of that filing that explains the expenses that have been incurred by the plan, benefits paid to participants during the year, total value of the plan benefits, and also if you are concerned about the foreign language population, that same foreign language rules for SPD also applies to the summary of annual report. Plan administrator must provide the summary annual report to participants within 9 months after the close of the plan year. This is 2 months then after the deadline for filing the Form 5500. So for a calendar year plan, it's the end of July for the Form 5500 filing deadline, the end of the end of September, then, if I've got that right, August and September, that you've got to distribute the SAR. If the Form 5500 is on extension to October 15th for a calendar year plan, then that SAR deadline is also extended by 60 days after that October 15th extended deadline for the 5500. Safe Harbor 401k notice. Most of the disclosure requirements really have to do with ERISA regulation. This Safe Harbor 401k notice is an IRS Department of Treasury required notice. And for those of you who do not have a Safe Harbor 401k plan, let me briefly discuss it. It's a plan design that is deemed to satisfy the 401k non-discrimination tests. And so if you satisfy specific requirements inside this Safe Harbor 401k plan, then you will get a pass on the non-discrimination tests that apply to elective deferrals, and in most cases, by design, you will also be deemed to satisfy the non-discrimination tests as they apply to matching contributions. So the main reasons, I think, why most employers adopt a Safe Harbor 401k plan design, I think the two primary reasons are, one, they've been having troubles with their non-discrimination testing, and the Safe Harbor 401k plan is a solution to that. The second reason is, I think that there's a lot of employers that really like the simplicity of the design and like the requirement that they have to provide participants with some sort of benefit, kind of on a guaranteed basis, although that can change from year to year. But in any event, one of the requirements for having a Safe Harbor 401k plan is that you need to provide a notice to the participants explaining the kind of parameters of the Safe Harbor 401k plan. As I said, this is an enrollment packet type of document. You need to provide the Safe Harbor notice each year within a reasonable time before the first day of each plan year. What is a reasonable period of time before the first day of the plan year? Regulations say it's 30 to 90 days before the beginning of the plan year. So if you have a calendar year plan, you need to provide your safe harbor notice to participants no earlier than October 3rd and no later than December 2nd. I think I saw an email. In fact, I saw some safe harbor transmittal letters on my desk earlier this week, and I think you should be receiving those shortly if you're a calendar year plan and you're a Union Bank client. That said, you could technically argue that less than 30 days before the beginning of the plan year is reasonable. That would be a facts and circumstances test that you would have to convince the IRS of if you ever had to prove that. However, the best practice is don't worry about facts and circumstances. Make sure you get that annual safe harbor notice in participant hands before 30 days before the beginning of the plan year. For new participants, provide within the 90-day period before the employee becomes eligible to participate in the plan, but no later than the date of eligibility. Again, an enrollment kit requirement. Not going to talk about the content requirements of the Safe Harbor 401k notice, but they're here on the next several slides. Auto enrollment notice. If you have an auto enrollment feature in your plan, you need to provide a notice to participants. So for those of you not familiar with automatic enrollment, it basically turns the idea of 401k on its head. So here's what I mean. In the typical 401k arrangement, a participant needs to make an affirmative election to have 401k contributions made to the plan on the participant's behalf. So I tell my employer, hey, I don't want my entire salary paid to me directly this year. Put 5% of my salary into the plan as a 401k deferral. And what that election does is it allows it to be play by the 401k rules. But the question is, what if we have a plan design that says, hey, John, we're going to put 5% of your compensation into the plan as a 401k deferral unless you tell us not to do this. And so what happens here is, does that become an employer contribution or does it become an elective deferral? And as long as you provide proper notice to the participant, then that will be an elective deferral. And one of the ways to get that default contribution to be treated as an elective deferral, we must provide the participant the opportunity to make an affirmative deferral election, something different than the default percentage that is going to go into the plan, including an election not to have any of the participant's compensation going into the plan as a 401k deferral. So there's different types of automatic contribution arrangements under the law, but they all share a common type of notice requirement generally, which is you need to provide the participants with a notice explaining what the default percentage rate is if the participant doesn't make an affirmative deferral election, in other words, to opt out of the automatic arrangement. You need to tell them that they can make a contrary election, including an election not to defer anything, and it ties in with the qualified default investment alternatives that we talked about last week, and we're going to talk a little bit more here about the notice requirements. If you need to explain how those automatic deferrals are going to be invested if the participant doesn't make an affirmative investment election. So right here we've got a participant who hasn't made any election to even participate in the 401k plan. No deferral election, so we're going to automatically enroll that participant into the plan. And then also, probably through inertia, if that participant hasn't made an affirmative deferral election, then likely that participant also hasn't made an affirmative investment election of how that automatic deferral contribution should be invested, and you need to explain to the participant how those deferral contributions are going to be invested. You should provide your automatic enrollment notice 30 to 90 days before a plan entry date, but not later than the plan entry date. Again, this is an enrollment packet type of notice. Before the beginning of each plan year, you also need to provide that annual notice, a reasonable period of time before the beginning of the plan year. Again, safe harbor, 30 to 90 days before the beginning of the plan year. That brings us to benefit statements. This is not an enrollment kit type of disclosure. You'll have noticed that I'm not talking about the penalties associated with the various disclosure requirements. I covered most of that last week, but to remind you, the benefit statement is a big one as far as potential penalties. This is that $100 per day per participant potential penalty. So you want to make sure that participants are getting their benefit statements, and participant for these purposes is anybody with an account balance under the plan, including beneficiaries and alternate payees. If you have a 401k defined contribution plan that is not participant directed, in other words, investments are handled by some sort of investment manager or a discretionary trustee that's investing the plan assets as part of a pooled investment, the benefit statements must be provided once a year. At least once a year, and must be provided on or before the date on which the Form 5500 is filed. If you have a participant-directed 401k, participants direct the investment of their own accounts, then the benefit statement must be provided at least once during each calendar quarter. And to be timely, the deadline for the quarterly benefit statement, it will be deemed to be timely if it's provided within 45 days following the end of each calendar quarter. Typically, we send out benefit statements about the 15th to 20th of the month following the close of the calendar quarter. So benefit statements should be in the hands of participants any day now if they're not already in their hands. Not going to talk about the content really of these benefit statements too much. It's basically what's in my account, what's vested. There is some model language that needs to be included in these benefit statements about the benefits of a well-balanced, diversified portfolio. The Department of Labor has model language and field assistance 2006-03, and you also need to direct participants to DOL website for additional information about investing. 404C type disclosures, these are going to be enrollment packet types of disclosures. Again, to recap, that 404C is the section of ERISA that lets all fiduciaries, plan administrator, plan sponsor, trustee, etc., to be relieved from liability resulting from losses to a participant's account resulting from the participant's investment directions. As we discussed last week, we need to provide participants with the opportunity to exercise investment control over their account, and they do indeed exercise such control, then we can avail ourselves of this 404C protection. And as we talked last week, the issue came down to, what if the participant doesn't exercise control over his or her account? In other words, doesn't make an investment election. Well, as we saw last week, we can, as long as we provided proper notices to the participant, we can invest that non-electing participant's benefits in a qualified default investment alternative, usually a target retirement type of mutual fund, and we should be able to get 404C protection. So we need to tell them the circumstances in which their account will be invested in a QDIA, and oftentimes this QDIA notice really goes hand in hand with an automatic enrollment feature. And if you have an automatic enrollment feature, then incorporated into the QDIA notice or provided alongside of the QDIA notice should be information given to the participant under which the circumstances of when automatic deferrals are going to be made, what that automatic deferral percentage is, and again, the right not to have automatic deferrals made to the plan, including the right not to have any type of deferrals made to the plan. You need to tell the participant that he or she has the right to direct the investment of his or her account. You're going to provide information about the QDIA, because remember what we talked about last week, in order to get our 404C protection, we need to provide enough information to the participant so that he or she can make an informed decision about how to invest that account. And in the case of a non-electing participant, we need to provide information about the QDIA, investment objectives, risk and return characteristics, fees and expenses, and the right to direct those planned assets in something other than the QDIA into other plan designated investment alternatives, and explain where the participants can obtain additional information about those other DIAs. You should be providing that QDIA notice at least 30 days before the participant is going to enter into the plan. Technically, under an automatic enrollment feature, it's 30 days before the date is automatically enrolled into the plan. And you should be providing that notice each plan year at least 30 days in advance of each plan year. Next, I want to talk about mapping notice, and it kind of works together with the blackout notice that we're going to talk about in a moment. But a mapping notice is, again, what we're trying to do here is we're trying to take advantage of 404C to relieve ourselves, our fiduciaries, from liability. But what a mapping notice does is it tells the participant, usually what happens is that there's going to be a new investment added to the plan, either because we've decided that there's a designated investment alternative that's been underperforming, and so we're going to remove it, replace it with a new DIA. The other common reason for it is if you change service providers, then invariably you're going to have a new investment lineup. And so the question is, what do you do with participant accounts when you're putting in a new fund or a whole new menu of funds available. The plan administrator needs to decide how that participant's account is going to be invested in the new DIAs if that participant doesn't make an affirmative investment election. So, again, to get our 404C protection, we need to provide a notice to the participant explaining what's going on. And as long as we map the old fund assets into a similar fund with respect to risk and return type of characteristics. In other words, if I'm removing a large cap fund and I'm putting in a new large cap fund, that would be acceptable mapping. If you're going to remove a large cap fund and put in a new small cap fund, that is not acceptable mapping because you're changing from a large cap to a small cap. It needs to be a like type of fund. To get our fiduciary protection, we need to give some sort of notice to participants 30 to 60 days before the date of the investment change. Typically, we do this at Union Bank through additional language in the participant benefit statement. And so if there's going to be a change in mutual funds, we're going to get rid of one fund and put a new fund in. We put this information in the quarterly benefit statement. We're explaining what's going on. We're going to compare the existing DIA that's being removed with the new DIA that's being added, and we're going to explain to them how this fund change is going to work, when it's going to happen, and that's going to be at least 30 days after the date they get that participant benefit statement in their hand. And we're going to explain in that notice, hey, if there's going to be, for example, a fund change on December 1st, you need to take your money out of the old fund that's being removed and put it somewhere else in the plan. And if you don't take any action before the date of the fund change, then those assets that are in the fund being removed are going to automatically be mapped over into the fund that's being added. Which brings us to the blackout notice. This is another big one, this $100 per day per participant potential penalty. And what the blackout notice does is it notifies participants if certain plan rights are going to be temporarily suspended. So if I can't do something with my plan benefits during a period of time, that's going to be a blackout period. Most of the time it occurs when the plan is going to change service providers. Now, the blackout notice needs to be provided whenever there's going to be a temporary suspension or limitation or restriction on a participant's ability to direct the investment of their accounts or to obtain loans or distributions from the plan. And a temporary suspension means that their rights are going to be restricted for more than 3 business days. And so this blackout notice is absolutely required if there's going to be a temporary suspension of benefits that's planned. Again, most of the time it happens when you're changing service providers. But if there's going to be a temporary suspension in investments, in other words, we're going to change service providers and we're getting rid of a whole menu of mutual funds and we're bringing a new menu in, and to balance accounts and make sure accounts that plan assets come over clean and are invested properly and such like that. In addition to the required blackout notice explaining this temporary suspension and the ability of a participant to direct his or her investment of the account, we're going to want to play under the mapping notice rules that we just talked about. And we do that mapping notice to take advantage of our 404C protection. So we're going to give advance notice. We're going to explain what's going on. Hey, you're not going to be able to receive a distribution for a certain period of time. So if you can't get a distribution, it's your distribution rights, for example, are temporarily suspended. We're going to let the participants know in advance, at least 30 to 60 days before the blackout period starts, to let them know, hey, if you need to take a distribution during this blackout period, you want to plan accordingly and take that distribution before the plan goes into blackout. So a 30 to 60 day advance notice. You need to tell them the reason for the blackout period. We're changing, for example, service providers. You need to identify what rights are going to be affected. Are distribution rights going to be affected? You can't get a distribution for a period of time during the blackout, or you can't receive a loan, or you're not going to be doing you're not going to be able to change your investment elections during this blackout period. You have to let them know what rights are being affected. You need to tell them the beginning date and the length of the blackout period and the expected ending dates. Alternatively, you can specify the calendar week in which the blackout period is expected to begin and expected to end. And also, if you're going to give this kind of more wider range of calendar week, you need to be able to tell the participants when and how they can receive information about the blackout period. In other words, are we in it? Has it started? And when is it expected to end? If your blackout period has something to do with temporary suspension of investment rights, you need to tell the participants that, hey, we're entering blackout period, and you might want to take a look at your asset allocation before we go into blackout, because if you want to make some changes to your investments, you need to do so before the plan enters a blackout. And you need to provide participants in any type of blackout notice contact information for the plan administrator where they can get more information about the blackout period. Brings us to participant fee disclosure. So that mapping notice and blackout notice were not enrollment kit type of notices. The participant fee disclosure is an enrollment kit type of document that needs to be provided to all participants. And this participant fee disclosure really has a couple of different purposes, I guess, in that it's fairly new. And what the Department of Labor said a few years back, it says that if you have a participant-directed plan, then you need to provide your participants with enough information to let them know how to make an informed decision about how they invest their plan benefits. It's a plan administrator responsibility, and Department of Labor said this is required under exclusive purpose and our prudence rule that we talked about. And so if you don't do this, this is a breach of fiduciary duty. But it also serves a dual purpose of letting us get 404C protection. Because remember, in order to make an informed decision of how to invest your account benefits, you need to provide specific information to that participant. And as long as we jump through the hoops, we should have 404C protection. You should provide the participant fee disclosure on or before the date the participant can first direct investments under the plan, with an annual disclosure thereafter. If there's going to be change in this annual information, you should provide notice 30 to 90 days before the effective date of the change. Again, that can be plan fees, it could be change of investments in it, for example. And so when they get the participant benefits statement that talks about the new investment option that is going into the plan. That's the purpose of that as well. You need to tell participants about their plan. You need to identify the plan's designated investment alternatives. Describe any brokerage window. You need to provide expense information. This can be the general expense information that all participants have. Legal fees, Form 5500 fees, record keeping fees, trustee fees. If the employer is paying these fees, you don't need to disclose those fees to participants. You only need to disclose fees if participants are going to be paying those fees out of their plan account. And general administrative fees, we're not talking about the operating expenses for mutual funds, those DIA operating expenses. Also, individual expenses. For distributions, quadros, or loan processing that not everybody has, but that are individual to the participant receiving that service. You need to provide a whole lot of information about the plan's designated investment alternatives, performance information, fee information, benchmarking information. Tell them where they can find out more about investing through some sort of glossary. That investment information needs to be provided in the form of a comparative chart. Also, the participant fee disclosure requires a quarterly disclosure, and that's going to happen in the form of the benefit statement. You need to tell your participants the fees that were charged to their account for the preceding quarter, either by liquidating shares from their account or deducting a dollar amount from their account, describing the services that they received for those quarterly fees, and if there's any type of revenue sharing, 12B1 or sub-TA fees, an explanation that some of the expenses were paid out of the operating expenses of the designated investment alternatives. Finally, with just a couple of minutes left, I want to briefly talk about electronic disclosure because we often get questions about it. The IRS and Department of Labor, in my opinion, have both teased the concept that they're going to be moving more and more into the electronic world, either by being able to provide notices and information through email or through some sort of website kind of kiosk sort of thing. It really hasn't happened yet. Understandably, they're concerned at while a huge segment of the population has access to the internet and such, there is still a sizable portion of the population that doesn't have access to this, and so they haven't moved quite as quickly as a lot of pension practitioners would like. That said, here's my kind of takeaway for electronic disclosure. And now there's different rules for IRS or DOL. IRS Treasury regulations describe when you can provide electronic disclosure for participant distribution notices, safe harbor 401k and such like that. The Department of Labor really talks about when you can provide use electronic disclosure for SPDs, SMMs, SARs, benefit statements, and the like. But really, how I've kind of boiled it down to is electronic disclosure really makes sense if your workforce has a computer on their desk. In the IRS world, there's two ways you can satisfy electronic disclosure. One way is the consumer consent method, and this is a bit cumbersome because before you can provide notices and the like electronically, there needs to be consent, and before the participant can give consent, you must provide specific notice explaining the scope of their consent, their right to withdraw consent, etc. Basically, an explanation of how they can get their documents via electronic means. There's an alternative way to the consumer consent method, and this is, again, kind of what I call that computer on desk method. You don't need prior consent as long as the recipient is effectively available. It can effectively access the communication. In other words, send me an email and I'll get it because my job requires me to have a computer at my desk and I can effectively receive it. That said, the participant under this method has a right to request to receive the notice in writing at no charge. That's not necessary under the consumer consent. Way to do it is because they're actually consenting to receive this information in electronic form. Department of Labor, same sort of thing. There must be some sort of measure taken to make sure that the notice is actually received by the participant through a return receipt request sort of thing. At the time you're going to deliver that document via email, for example, you need to explain the significance of the document. Tell that participant that they have a right to request a copy in writing free of charge of that disclosure. The Department of Labor doesn't necessarily divide the world into consumer consent and the alternative method, but they really do through a different method of really categorizing or classifying the recipient of the notice. So if you've got an active employee who's integral, I'm not saying that word correctly, part of his or her duties is to access the employer's electronic information system. In other words, computer is on my desk. You don't need my consent. If you've got a workforce that doesn't have a computer at their desk, then you play under this other rule for the other employees and beneficiaries, which is you need to have consent before you can provide information to participants electronically. As I said, practitioners have been wanting to maybe be a little more, that IRS and DOL be a little more lenient with respect to consent requirements. We're not there yet, but I think eventually we're going to get there. So, gone a couple of minutes over. That's the end of my prepared remarks for this week. If you have any questions, be glad to answer them. And again, to repeat, you can always give me a call or email me at any time if you have any questions at all. Thank you.